Hi, and welcome to the third section of this chapter on stocks. This is the Personal Finance course. I'm Tom Mihawk, and I'm glad you're back. So, given that we've talked about how to select stocks, how to decide if like a $80 pair of sneakers or $150 pair or $350 pair, why do we choose some that have higher price earnings ratios than others or higher prices than others? We look at things like their dividends and how quickly they're going to grow. We talked about the efficient markets hypothesis. Big impact on finance and tells us a lot about a huge movement in the last, say, 20 years, which is investing in passively managed index kinds of funds and keeping expenses low. Do some people who try to beat the market beat it? Yes, sometimes. But in the majority, they don't. So, okay, so having done all this, so how should I invest? What should I do? Well, have a bias for stocks. As Roger Ibbotson and Jeremy Siegel have shown us going back to 1802, stocks provide a premium over other securities. For the long term, they provide returns that are greater. They are more volatile. Your returns go up and down more, for sure. And that's why you would want to invest using stocks for the longer term. Own more stocks than anything else for the long term from a percentage standpoint. Diversify to reduce risk. You can increase returns for the same risk or lower risk for the same returns. Diversification meaning own a variety of stocks, a variety of bonds, whatever asset class you're using in tech stocks, pharmaceuticals. Diversification allows you to go up when others are going down or not go down as much when they're going down or provide more return for the same risk. Be aware of taxes. Own securities for the long term. In the investment fundamentals chapter, we talked about the value of not missing the best 10, 20, 30 trading days in the market in a year. Own stocks for the long term. To get long-term capital gains tax treatment, use the preferential tax treatment in qualified retirement plans like in 401ks and IRAs that allow you to not be taxed until way in the future. Or in the case of Roth IRAs, that's traditional. In the case of Roth IRAs or 401ks, pay your taxes now, but never pay a capital gain while your investment is growing. Keep fees and costs low. Have a bias for index funds, meaning passively managed funds where you're investing in the average of the market. Since most active funds don't beat their indexes, they don't beat the market. Most. Not all, but most don't beat the market. Some active investment funds and investments do, however. And so if they're consistent or they're exceptional, use them. You don't have to be, some people are, I only own index funds, only own passively managed funds. And for some, that's great. I had a very wealthy client, and he was taking his money out of, as he was being paid by the buyer of his company, for his equity interests in the new firm, as he was being paid cash, he invested it all in Vanguard index funds. And I'd say, why are you investing all in Vanguard index funds when all of your management in your current firm is actively managed? And he said, well, if I find an investor portfolio manager that beats the market this year, they may not beat it next year. His way of saying that it's inconsistent. So if you can find consistency and they beat the market by an exceptional amount, use them. And remember that a 0.5% better annual return over the long term makes a staggering difference in outcome. A 0.5%, not per year, not in 1 year rather, or in 2 years, but a 0.5% per year for 40 years makes a huge difference. Is it possible to get a 0.5% a year? Yeah, particularly if you review your performance regularly, implement and make changes, rebalance as needed. Rebalance meaning if your goal is to have 80% stocks and 15% bonds and 5% money market funds in a portfolio, and the market's done really well, and now you find yourself with 90%, rebalance every so often to get back to 80, because 80 is your strategy, the amount of stocks you want to have in your portfolio. The rule of thumb is generally 100 less your age. That's the amount you should own in stocks. If you're 25, you should own 75% in stocks and 25 in bonds. If you're 50, it would be 50-50. That's changed. Some people today say, well, maybe it's more like 120 less your age, 120 less 50, 70% stocks, 30% bonds. But that gives you some rule of thumb. So review your performance regularly, make changes, and if you do that, finding an extra 0.5% a year is very possible. And if you do that for the long term, it makes a staggering difference. So this is, in result, how you should consider investing. Measuring stock performance. How do we measure? We have a few slides remaining, and then we'll summarize at the end, but a few stocks just describing stock markets and measuring stock performance. Alpha, we talked about in the investment fundamentals chapter, is the return in excess of the expected or market return. It's the amount greater than what you expected to get. That's alpha. And you should pay for alpha. If someone produces greater than market returns, greater than average, shows that the efficient markets hypothesis maybe is incorrect. If they can produce that consistently, you would pay more for that because on a net basis, you would have a return greater than the average of the market, even with low fees. Beta, measure of one security's price movement relative to another. If you're buying an index fund, you're getting all beta. The market goes up, the fund goes up. Market goes down, the fund goes down. You're getting the average return of the market. Alpha is when the market does this and your fund does that. Or when the market's down like this and it's only down a little. That's alpha. Fundamental analysis uses economic and financial factors like a company's financial statements to determine intrinsic value. It's sometimes called bottoms-up investing. It's using economic and financial factors such as company financials to determine value. And technical analysis uses charts to look at price and volume activity over time to make projections about what prices may be in the future. You'll see these often with charts, and there'll be lines and dotted lines and things that show, the last top to the next top and a projection of what it may be in the future. And technical analysis is used also, as is fundamental analysis. Where do you buy and sell stocks? Online, you can do it. In person, you can do it. By phone. These days, it's made to be easy, and so you can do it in many, many ways. Who does it? Banks, brokerage firms, mutual fund companies. And there's a spectrum of costs. The most expensive, full-service firms. These are the brokerage and advisory firms that take you golfing, invite you in for coffee, and maybe take you to dinner from time to time. They have higher fees. Discount firms are low. The fees are low and getting lower. And free these days, like Schwab, Fidelity, and Vanguard offer free brokerage, free buying and selling of stocks. The stock exchanges are where stocks are bought and sold, and it's kind of changing from an open outcry system, which you see on TV, where you have people, yelling. If you remember the movie Trading Places, they were selling orange futures, and they're yelling. Someone's yelling a price, and someone over there is buying, right? And changing from an outcry system to an open outcry system to an electronic system. The NASDAQ today, 2 down, is all electronic. It happens all by computer. The New York Stock Exchange is the world's largest exchange. It still uses some of the open outcry system, and some is electronic too. And I wouldn't be surprised if at some point in the not so distant future, it's all electronic. Over-the-counter market is for smaller companies. Other important markets are the London Stock Exchange and the German Bourse. There are others too, but these are 2 large ones. There are 2 kinds of generic markets. The primary market, where stocks are sold initially in their initial public offering, and the secondary market, where stocks are bought and sold after the initial public offering. These are for the buying and selling of seasoned securities after they've been initially offered. Some people think there's a merit to offering buying stocks in the initial public offering. There's benefit. Sometimes the price goes down too, but often there's pent-up demand by companies like a few years ago, Facebook, for example. Some common stock market orders. A market order is to buy or sell at the then current price. If they're willing buyers and sellers, market orders will execute. Market orders are used when the certainty of execution is most important and price is less important. It means you say sell the stock, whatever you can get, or buy it. I want to buy Apple, whatever it is, buy it. By comparison, a limit order buys or sells a stock at a specific price or better. Buy limit orders are only executed at the limit price or lower, and sell limit orders are only executed at the limit price or higher. Limit orders are not guaranteed to execute. If you say, I own this Apple, sell it at $150, and if it never reaches $150, it won't sell. Or if the stock gets below 125, sell it. And if it never gets below 125, it won't be sold. I meant buy, I'm sorry, in the example before. If it buy it at 150, sell it at 125, for example. These are ways of limiting your risk. And the stop loss order is to buy or sell a stock once it reaches a certain price. It's designed to limit losses. One other thing I should talk about that's not shown on this slide is our stock splits. And stock splits are when a stock price, generally is when a stock price is increasing rapidly. And if it goes from $50 to $100 and the company decides, we want to keep it in the $50 range so that people will still purchase it, so it's still affordable. And so what they do is they split it from 100 back to 50, and instead of owning one share at 100, now you own 2 shares at 50. Do you really have more value? No. Does a stock split communicate increased value? Maybe, because it's when the stock price is going up. Maybe. There are 2-for-1 splits, 3-for-1 splits. 2-for-1 would be the example I just gave, 100 back to 50. You owned 1 share at 50. When it reached 100, you had 1 share. Split it to 50, you now have 2 shares. There are 3-for-1, 4-for-1 splits. I worked in the beginning of my investment banking experience on a reverse share split. The company was small, it was trading at, 50 cents or $1, and a reverse split, a 10-for-1 reverse split, if the company's trading at $1, would bump it up to $10 a share. So instead of owning 1 share at $1, you now own 1/10 of a share. You own 1/10 of a share at $10. Sounds crazy, but it makes the stock look more attractive. That's a reverse split. Most are forward splits, 2-for-1, 3-for-1, as I said. So summarizing, last slide in this section, and it's a review of what we did before. Have a bias for stocks. All indications over the long term are that stocks produce higher returns than other securities. And having a bias for stocks means a greater return for your investments over time. Use diversification to reduce risk. Some research says only 25 securities are enough to diversify. Most funds have many more than that. So diversify to reduce risk. Be aware of taxes. Hold securities longer. Take advantage of long-term capital gains in retirement funds like 401k plans and IRAs. Take advantage of those when you have access to the preferential tax treatment offered in these qualified retirement plans. Excuse me. Keep fees and costs low. In general, passive investing, earning the return of a market or an average group of securities, earning that return is what benefits most people. If that's the case, and if you invest that way, keep your costs low. However, some active funds and investments do beat the market, not in the majority. And if they do it, however, consistently, or they provide an exceptional return, use them. Just know that on average, actively managed investments don't beat the market. And review your performance regularly. Make changes. Rebalance as needed, implement the changes, because if you review regularly and implement, you can produce maybe this 0.5% return per year, which over time, 40 years, can produce staggering differences in outcomes. The difference between a good retirement and a great retirement, for example. And you can produce this by reviewing your portfolio regularly and making changes, prudent changes, that can produce just small positive changes in return. So that's it for this third segment of the stocks chapter. That's it for the stocks chapter. I'm Tom Mihawk, and thank you for watching.